What if I told you the next decade could transform your financial future? Technology is reshaping everything: AI, cloud computing, electric vehicles, and more. The innovations happening now are creating massive opportunities for early investors. Imagine being an early investor in the internet boom. That's the scale of what's possible today. But where should you put your money to capture that growth? We asked ChatGPT, the most advanced AI, to analyze the tech landscape and pick the 5 technology ETFs with the highest potential for wealth over the next 10 years. These aren't random stocks. They're diversified funds designed to give you a piece of the entire tech revolution. We'll break down each one, looking at their holdings, performance, and why AI believes they're set for explosive growth. Let's get started. First up, the Invesco QQQ Trust, ticker QQQ, a titan in the investing world. QQQ gives you access to the 100 largest, most innovative non-financial companies on the NASDAQ. When you buy QQQ, you're buying a piece of the entire NASDAQ 100, Apple, Microsoft, Amazon, Nvidia, and more. These companies are the architects of our future, driving innovation in everything from AI to cloud computing. QQQ's historical performance is outstanding, about 17% annualized returns over the last decade. A $10,000 investment 10 years ago would be worth over $48,000 today. That's the power of compounding in high-quality companies. QQQ offers instant diversification and simplicity. No need to pick individual winners. Its low expense ratio, just 0.20%, means more of your money stays invested. Fees can quietly erode returns, so low costs are critical for long-term wealth. QQQ blends growth and stability, with exposure to tech giants and innovative newcomers. It's ideal for investors wanting a core holding in elite high-growth companies. If you believe the biggest innovators will keep leading, QQQ is a foundational ETF. In summary, QQQ delivers diversification, strong returns, and low costs. It's a one-stop shop for investing in the NASDAQ's top innovators. By holding QQQ, you're aligning your portfolio with the companies building the future. It's a cornerstone for any tech-focused, long-term growth strategy. Let's move to the next pick. Next, the Vanguard Information Technology ETF, VGT, for those who want pure tech exposure. VGT focuses exclusively on U.S. technology companies, from megacaps to emerging players. You get deep diversification within tech, software, hardware, semiconductors, and more. Top holdings include Apple, Microsoft, Nvidia, Broadcom, and Salesforce. Over the past decade, VGT has delivered an astonishing 20% annualized return, outpacing even QQQ. A $10,000 investment 10 years ago would now be over $61,000. Its concentrated focus on tech has driven this outperformance. VGT's expense ratio is just 0.10%, half the cost of QQQ. That means more money compounding for you, not the fund manager. ChatGPT picked VGT for investors bullish on American technology and wanting sector-wide growth in one low-cost package. It's a direct bet on the innovation coming from Silicon Valley and beyond. VGT is perfect for long-term investors who believe in the enduring power of technology. If you want comprehensive exposure to the U.S. tech value chain, VGT is a robust choice. It strips away non-tech components, giving you a direct line to American innovation. Its stellar track record and rock-bottom fees make it a top tool for building long-term tech wealth. For the tech purist, VGT is hard to beat. Now, let's look at a more specialized play. The VanEck Semiconductor ETF, SMH, focuses on one of tech's most explosive subsectors, semiconductors. Semiconductors power everything from smartphones to AI, cloud computing, and electric vehicles. SMH tracks the 25 largest US-listed semiconductor companies like Nvidia, TSMC, and Broadcom. Over the last decade, SMH delivered about 24% annualized returns. A $10,000 investment would have grown to nearly $86,000. The expense ratio is 0.35%, higher than broad ETFs, but reasonable for targeted exposure. With SMH, you benefit from all these trends, no matter which company wins. The industry is cyclical, but the long-term trajectory is up. SMH is a unique way to invest in the backbone of tech innovation. The Technology Select Sector Spider Fund, XLK, is a top choice for cost-conscious investors. XLK is one of the oldest and most popular tech ETFs, known for simplicity, liquidity, and ultra-low cost. You're investing in blue-chip tech companies, the backbone of the US economy. Top holdings are Microsoft and Apple, often making up over 40% of assets. This top-heavy strategy has paid off, about 19% annualized returns over the last decade. XLK's expense ratio is just 0.09%, one of the cheapest ways to get tech exposure. ChatGPT picked XLK for its blend of performance, low cost, and high quality. If you believe mega-cap tech stocks will keep driving the market, XLK is a near-perfect solution. Last, the iShares US Technology ETF, IYW, caters to investors who want to lean into tech growth. IYW tracks the Russell 1000 Technology Index, focusing on US tech companies with strong growth characteristics. It's less about pure size and more about capturing the most dynamic, innovative companies. Top holdings include Microsoft, Apple, Nvidia, and Alphabet, Google, giving it a unique flavor compared to other ETFs. IYW's performance is impressive, about 19% annualized returns over the past decade. A $10,000 investment would have grown to over $57,000. Its growth-focused strategy has been highly effective at capturing tech's top innovators. The expense ratio is 0.39%, the highest on our list, but it offers a distinct growth tilt and unique exposure. For investors who believe in this strategy, the higher fee may be worth it. ChatGPT picked IYW for its nuanced approach, not just market cap, but broad US tech with a growth emphasis. Including companies like Alphabet gives IYW a different risk and reward profile. IYW is ideal for growth-oriented investors seeking capital appreciation and exposure to the most innovative segments of US tech. It's for those willing to pay a bit more for a laser-focused, future-oriented strategy. In summary, IYW rounds out our list with a distinct, growth-focused lens on tech. It combines mega-cap stability with a mandate to capture innovation across the industry. Now let's wrap up. There you have it. 5 powerful tech ETFs handpicked by ChatGPT that could help build serious wealth over the next decade. We covered QQQ, VGT, SMH, XLK, and IYW, each offering a unique strategy for capitalizing on tech innovation. The key, you don't have to be a stock-picking genius. Low-cost, diversified ETFs let you ride the tech revolution. The next decade promises incredible change. Having a stake in that is a smart move. Tech is the future, and these ETFs give you front-row seats. Hold them for the next 10 years, and history suggests you could see powerful gains. Subscribe for more strategies and click the next video to keep learning and investing smarter.